Hello, I'm Piyush Dave, a fintech professional, and today I'm going to show one more algo which is mixture of RSI and ATR. So I created a real-time simulation of the market, and in this real-time simulation, how RSI behave and how ATR help to save our capital by changing the position sizing with the change in volatility. So RSI is going to trade, ATR is going to change the position sizing, and we have created a real-time market simulation with news flow. So what is happening in total algo? A random news come into the market. Now based on that random news, the price is going to react. Based on this price, the RSI is going to fire the trade, and how much quantity to trade it is being given by ATR. Suppose you have capacity of 100, but ATR will tell you how much number of quantity to trade. RSI will tell you when to trade, when not to trade. The price reaction is basically depend on the news which is coming up. So in the simulation environment, I created different news like positive news or a good news, best news, neutral news, bad news, and worse news. So this video is going to show you how the realistic market simulation works, how the real time price movement taken place, then what is the news driven behavior of the market, event behavior, volatility. So we will try to understand all this in just one video. And this is a realistic market behavior. Realistic market behavior. So I divided this into three parts. First part, we will try to understand this, the news and the price reaction. Second, we will try to understand the RSI. And the third, we will try to understand what is ATR. Okay, so let me explain one by one. So this will make you understand all part in detail. First, I created 5 different sentiments in the market. Normally, the news come either in seconds. Sometimes news does not come for a month or a year also. So that means the market is normally behaving neutral on a supply and demand. If there is a huge supply, then market is going to go down. If there is a huge demand, then market go up. That's a simple common logic. But now this supply and demand is work with the logic of news flow also. If the good news is coming, then there is a demand. If the worst news is coming, then there is a supply. So what we will try to do over here, we will create this kind of a news flow artificially. And we will check what is the market behavior. Now to show you this in a very realistic environment, I created this news flow in a random nature. So even I am not knowing which news is going to come. So continuously there will be a good news, bad news, and that has been created with a logic of 10 to 20 seconds. That means between 10 to 20 seconds of continuous simulation, we are going to see a news which is coming up. There will be a negative news, there will be a positive news. So that could be possible in every 10 to 15 seconds. And we are going to see what is happening in that kind of a news which flow. So now what is the reaction of a price when the news flow? If the best news come, the stock may go 3% up. So I put a simple condition. If there's a random news best come into the market will check that news and start behaving positively. And it start behaving positively in a way that it is going to go up by 3%. But in a 20 step. Next, if the good news come, then the market behave positively again, 2% up. Like if there's a neutral news flow, normally I created an environment that majority time neutral news will be there. That means no news. Then price is basically flickering up and down, maximum of 2 to 3 points or maximum of 5 to 8 points. Then if there's a bad news coming in the market, then the stock may go down to 2%. If the worst news come, then it may go to 3% down. And if there is a no news in the market, like there's a neutral news or no news, it drift 1% or minus 1%, but that too very randomly. So in the first part, we try to understand how the market reaction take place based on supply and demand. If there is a supply, then market fall. If there's a demand, market go up. Now that is basically depend on the news which is coming up in the market. If there is no news coming up in the market, based on the supply and demand, the market may go up and down. But if there is a news flow in the market, then it basically change everything. Based on the news, the price may go up or down. Now, once we do that process, we will try to understand what is the meaning of RSI. So RSI is relatively strength index. Now it basically help us to take the trade in this news driven realistic market environment. We are going to collect first 15 prices, and from these 15 prices we are going to calculate the RSI. If the RSI is below 30, then we are going to buy, and if it is above 70, then we are going to sell. We are going to take a profit at 0.5% and loss at minus 1%. Now I intentionally created this loss environment because the RSI is supposed oversold and it has taken a long trade, and suddenly a bad news has come. We are in a long trade, bad news has come, market is going to fall 2% to 3%, and you are going to get a bigger loss. So that's why I kept the stop loss. When I use only RSI, then there was a huge loss. So that's why I combined RSI and ATR in this algo. So RSI will tell me when to trade, and ATR will going to tell me, that is average to range, is going to tell me how much quantity to trade. So if there is a huge volatility, then we are going to trade in a small quantity, and if there is a small what we can say volatility, it is going to trade larger number of quantity. So once we do that process, we are going to understand the ATR. Now RSI is very much clear. Okay, RSI exit is depend on if the value come above 50 or below 50. So that's basically a exit or a normalization. Or if there is a complete 5% drop in the capital, we are going to stop the trade. Great. Now we will try to understand ATR. ATR is average to range. So first we will going to calculate the TR. TR is to range. So that will be calculated from the previous price and the current price. Once we do that process, we are going to collect this average, true range, previous price minus the current price. That's we are going to do it again and again for almost 14 times, because we have 15 cycles. And after that, we are going to divide these 14 signals which we have taken from the 15 candles, divide by 14. So we are going to get the average of true range. Once we get the ATR, we are going to find out what is the minimum of that. So the minimum ATR of the 14 readings, the minimum ATR of the maximum ATR of 14 readings. So that will give us the ATR minimum and ATR maximum. So we can scale up ATR in between 0 to 100. Once we get that, we are going to normalize it. So when you normalize it, it become more smooth and there will be no problem to understand the ATR. Once we calculate the ATR, we are going to understand whether the ATR is small or ATR is large. If the ATR is small, that means the safest market, we can trade with maximum quantity. And if the ATR is very large, then we are going to trade with smaller quantity because it's considered to be as highest volatility in the market. Okay, once we do that process, what we are going to do? We are going to find out first ATR, then ATR score, the suggested quantity, and we will going to understand whether the market is safe or not. Higher the ATR, fewer quantity, lower the ATR, more quantities. Okay, now let me take the exact example to count the ATR. So the value which we have taken is this value. So let's consider the ATR is 8 of these samples. So if the ATR is 8 of this sample, what is the max value in this complete part 10? What is the mean value? 4. And the ATR which we have calculated from this is 8. So the normalized value is 0.66. ATR minus ATR mean divided by ATR max minus ATR mean. Once we do that process, we are going to find out the ATR score. Now we are going to keep this ATR score in this formula, the formula of suggested quantity. So this requires 1 minus ATR score multiplied by 100. We are going to take an integer of it so that if the value comes 33.33, we are going to trade to 33 because 33.33 quantity is not possible. Okay, so first part is we have got the ATR. If the ATR is 1, then answer is going to come as 0. That's why we kept a condition max of 1 comma this value. Suppose if this value is more than 1, then this value will be considered. And if this value is 0, if the ATR score is 1, then this value is going to be 0. Then we are going to trade with at least one quantity so that we can be in the market with smaller number of risk. So the complete logic, let me explain it one more time. We are going to create a realistic market behavior. Next, we are going to work with a news flow, a news continuously coming in the market, and that too in the random nature. The price react on the news, and the change in price will help us to trade based on RSI. RSI is going to fire the trade, and ATR is going to tell us what quantity to trade. RSI is for trading. ATR is to tell me what the size of the trading. News randomly generated so that the price reacted like in a live environment in the realistic market simulation. It's an event-based volatility has been created, and news-driven behavior also created in the simulation environment. If the volatility is very high, we are going to trade small quantity. If the volatility is small, we are going to trade with maximum quantity. So that is the main logic of this algo. So let me show you this in a realistic environment using the code. So now this is my file where I created a random news. So there will be a lot of random news will be coming like neutral news, best news, good news. I created a weight like maximum time the weight neutral news should come. Then the best news or good news. I've given this random frequency so that we get a different kind of a behavior every time randomly in the news flow. So when I run this, we'll come to know, okay, there's a news is generated and it's bad news. And it says, okay, there's a supply delay pushback in the product release. So the news is generated, the market is going to react on this news for sure. Okay, the best news is generated. Okay, they basically try to solve that product driven demand in a record time. Okay. See, neutral news, no major updates. Business is running as usual. So this is going to be generated every 10 to 15, 10 to 20 seconds. In between 10 to 20 seconds, this news will be generated. So that's a random news generator algo. We have no control over it. And in the market also, we get this kind of a random news every time. So this once we generate this kind of a news, we now check the market behavior on this random news. So let me show you how market behave with this random news. We are going to see all the three windows at the same time. Okay, once we get this kind of a news, we are going to start our exchange. Now this exchange has been designed in a way that if there's no news, the market go up and down normally. But if there's the best news, the market is going to behave in a way that 3% up, neutral news, no change, bad news, 2% down, and so on. So it is going to behave uh, like a real markets environment. Let me run that. Okay, it has detected the good news and the market start going up. You can see market is going up and down based on the news which is flowing. Now let me take both the window together so that we can see what is happening in the news and what is happening with the price. Okay, both the window together. Neutral news, market is drifting a very micro steps. Good news, 2% is going to go up. Market, in the actual market also, it behave after 10 to 15 seconds of the news come. See, the market has got the good news and you can see the change in the price is so fast because there's a huge demand come. Okay, now there's a neutral news. I kept maximum of the neutral news so that the real market scenario is like suppose increasing or decreasing. We can see that with micro drift. Now we got the continuous neutral news. The market is behaving in a very normal way. It's going up or down with that neutral news. Okay, one more neutral news. Great. So market is very steady condition. Very steady condition. If I check the ATR in this, then it is going to tell me, okay, trade with maximum quantity. Trade with maximum quantity. Okay, bad news has come. Okay, the market is going to fall like anything. You can see the market is fall to 2% of its value. Okay. Best news has come again, 3% up. So the market is behaving to take a steps 3% up. So now this is called as a one kind of a volatility. Like 2% down, 3% up. It's a kind of a volatility. On this environment, my algo is going to tell me, okay, trade with small quantity. This is also kind of a volatility created. Volatility does not mean it should go down. Volatility means it may come up, may come down. Now let me start my algo also, which is going to work with these two things. Okay. So now the algo has started collecting the price from the market. Now let me adjust all the windows so that we can see all behavior together. So this is my news flow. This is my price flow. And this is my algo. News is flowing. Worst news, 3% going down. We are collecting the price from the market. I created an intentional delay. Okay, we have taken a long entry because it says ATR is very oversold. Oversold. We have taken a long position, but with only one quantity because the volatility is very high. ATR says, okay, you want to trade it, no problem, but with very small quantity. Okay, ATR is suggesting only one quantity to trade. because the ATR is very high. And you can see, okay, now the ATR might change. Okay, we got one realized profit. We have stop loss. Okay, again, okay, when the market, okay, we took the profit at 1200. Great. It's so happening so fast. Okay, the market is uh, in a neutral form. The ATR is going to go down. We are trading at complete 100 quantity. Okay, currently we don't have any position because RSI is not below 30 or above 30. It's just suggesting me the quantity. We are not in a trading mode. Okay, the RSI is increasing because the market is going up. Okay, we have taken a short entry. But ATR is very high. So the short entry with only and only one quantity. Short entry with only one quantity. Okay. ATR is below 50, so it has taken the profit. Good news has come. ATR is very high, so it's not telling us to trade with maximum quantity. Even if the RSI go up, it is not going to tell us to trade with highest quantity. The current ATR is 4, you can see. The max ATR is 4.8. So it's very near. Okay, see here, the ATR has dropped down, so the quantity automatically changes. If we get a trade over here, we are going to trade with 77 quantity currently. So currently no trade. The ATR has now dropped to minimum of the value. And the market says, okay, trade with 100 quantity. The market has fall like anything. We are going to change the ATR and the quantity will be changed again. We can see based on market behavior, we are changing our quantity. Now this could be very difficult in doing this. Okay, we got a long entry. We got a long entry. Okay, we have, I think, long entry 45 quantity. We got one stop loss also. 45 is a quantity which we are trading. You can see in just 45 quantity we got a loss of 1000. Now consider that you are in 100% of the quantity. Currently the ATR is below, so we are in a long position with 45 as a quantity. It's saying, okay, you want to trade again, then you can trade for 100 quantity. Okay, market is falling. We are in a long position. We got a stop loss. It's completely fine. We got one more long entry. The reason behind long entry is the RSI. RSI is below value. Okay, we are going to got one more stop loss. See, if the interesting part is, okay, stop loss triggered again. If this kind of environment is happening and we are trading with 100 quantity, then we might have blow the complete part. But the main advantage is we are changing our quantity again and again. The ATR is maximum, the volatility in the market is maximum. You can see the price is going up and down like very fast. Even if the RSI is small, it says ATR says, okay, don't trade. Only 1%, one quantity you can take a trade. We are in a loss, it's completely fine. But this will help us to take a trade. Only if I use only RSI. In one algo, I only use RSI, not with ATR. There was a 2-time complete 5% drawdown of the capital. 5% drawdown 2 times in back-to-back part. So that means if I'm trading with my full capacity and if there's a huge volatility in the market, then there's a very few chance that we may save the capital. But with the combination of RSI and ATR, it helps us to, okay, we must take a trade on RSI. Okay, we have taken a trade but very small quantity because on that time might be the RSI was, the ATR was very high. Currently the ATR is very small because there's a continuous neutral news is coming. We need to fine tune this by changing again and again a lot of things. We need to back test it with a lot of parameters. And one more thing, this is been created by changing the price in every 10 seconds. See, this kind of a behavior market does not have in normal days. So that's why it works very nice in a real market scenario. But here I created the worst environment. I created a worst environment. Okay, the ETR is very small, but the thing is, okay, we got a short entry. We got a short entry with 66 quantity. Okay, good news, the stop loss is going to trigger. See, we are in a short entry due to RSI and we were trading with small quantity. Otherwise, okay, there's one more stop loss is going to happen, but with very small quantity. Okay, stop loss has happened. It says, okay, trade with only 16 quantity, don't trade with more because the market is going against you. See here, the RSI says short it, ATR says the number of quantity. If I was, if uh, if there was no ATR in this, then this might be more than the value you cannot even think of. Because see, in this we created a so much volatile market. Still, the ATR is saving us. RSI is trading, ATR is saving us. RSI is behaving like a normal calculation which is given to the RSI, but ATR is saving us. It's a real market simulation. Real market simulation. The main advantage is, see, this kind of a environment happen only one or two time, not all day. So that's why we created a worst scenario to show you what can happen with the market, what can happen with the algo. I just want either it should increase the loss or at least it decrease the loss. So that's why I'm waiting on the market behavior. So this simulation environment create a bad news, good news in just 15 seconds. So that's why the parameter is changing so fast. But in real market same scenario, this kind of a news flow come one or twice a day, one or twice, uh, one or twice day in a month. So that's why we don't need to worry about, okay, RSI is above 56, ATR is in between the value. So that's why it's telling us, okay, trade with 76 quantity. Okay, the neutral news is flowing. The ATR is going to cool down. ATR is going to cool down. We're going to get the short entry for sure. Okay, we got one short entry with 70 as a quantity. Okay, the worst news has come. Okay, we have booked one profit. See, we basically reduce our loss. The ATR is high. It's suggesting us to trade with small quantity, but the RSI logic is not below or above the value. So that's why there's no trading happening. The worst news has come. The RSI is going to go down for sure. Okay, we took a long entry with only 30 quantities because the ATR is very high. The ATR is very high. Okay, we got a stop loss 320 rupees. We got one more long entry. The price is going down. We're going to get one more stop loss. See, the best part of the video is we are getting the highest volatility, and you wonder to know if I'm not using this ATR, then there is this could have been double, triple of this. So ATR is at the highest value. You can see the highest volatility happening in the market. Highest volatility. RSI says okay, do the long position, take a long position, but ATR is saying okay, you want to take a long position, take it with small quantity. We have taken a long position currently. Okay, there is a stop loss. See, with a very small quantity, we have taken a trade. Otherwise, this could be a worst. Currently, we have taken one more. Okay, this is going to complete our algo. Algo says, okay, I'm not going to trade because the capital drawdown has reached to 5%. Suppose you are running a multiple algo at the same time and the market behavior is like this and you have no control over what is happening with the algos. So there this condition would help you to work. The best part of the video is we got the maximum unpredictable news coming in the market. The market was behaving like very fast. Even if in this fast kind of environment, the algo has taken a lot of time to actually draw down the capital. This kind of a market are very rare, like going 2% down, up, down in every 10-15 seconds. So this kind of a drawdown is not possible. If it is happening also, still our algo is going to stop with very logical way. And if I'm not using the ATR, this might have went to more than that before we think. So RSI was right, but RSI does not consider news flow. RSI only consider the price reaction. So that's why RSI says, okay, take a long position because the RSI is below oversold. But why it is oversold? It can be more oversold also possible. Like if continuous worst news is coming, the RSI may go below 10 also in this condition. So that's why even if RSI says trade, ATR says trade with small quantity. So I hope this is clear, a crystal clear concept of the realistic market behavior of RSI plus ATR. Thank you very much.